Welcome. My name is Brian Bourgeois, CEO, founder of Shorebreak Capital. I'm so happy to be here with you and excited to share with you the 10 biggest mistakes that people make when investing. I'm also going to tell you 3 holy grails of investing that will make or break your investment strategy. And I'm also going to discuss Shorebreak Capital's platform to see if it's a good fit for you. If it is, please schedule a free consultation with Steven if you haven't done so already. He is amazing and he looks forward to talking with you, can help you out. It's absolutely free, no obligation. Take advantage of it. If you're interested in setting an account, then you can set up the appointment. If you make the appointment, then please keep the appointment. If you need to change or cancel the appointment, no problem, but please show up. If you don't show up, we're not going to reschedule. We want you to be as serious about your financial future as we are. So let's get to the 10 biggest mistakes investors make. The first biggest mistake is not working with a fiduciary. A fiduciary has your best interest in mind and makes recommendations based on your best interest. A broker or non-fiduciary does not have to do that. All they have to do is recommend an investment that is suitable under the regulator's definition of suitability. And that doesn't mean that that product may be the best product for you or the best strategy or the best program. And it most likely could cause a conflict of interest where you're paying more fees, for example, or not getting into the best program, or there's other conflicts of interest that are going to jeopardize the investment. So work with a fiduciary. Shorebreak Capital is a fiduciary. We're a registered investment advisor. We don't have any type of conflicts of interest or arrangements with anyone that are not non-fiduciary. So it's just fiduciary work with Shorebreak Capital. Most advisors out there are not fiduciaries. Most advisors are under a brokerage type of umbrella, which they bypass the fiduciary requirements. So just be sure, whoever you work with, you're working with a fiduciary, okay? The second is not using a platform with a proven track record. Okay. People have been investing for a long time. There's things that work. There's things that don't work. People have done things and built things that have created good returns for investors and a good platform for investors. Okay. So you don't have to risk your own capital. It already has been done. Everything's already been set up. Take advantage of the things that work. Don't worry about the things that don't work. So utilize a platform that has a proven track record. I have 20 years plus experience in the industry in investment management and financial planning. And we have partnered with one of the best investment portfolio management firms, Redwood Investment Management, which has $2.5 billion under management. They have a large team of analysts and traders and researchers that build out the portfolios and research the portfolios. Their growth rate is about 40%. So there's a reason for that because it's really, really good. And the platform is one that has put in a lot of thought and research and expertise to allow you to have a stress-free investment strategy that can help you obtain your goals sooner than you thought. Okay. So the third biggest mistake in investing is being greedy. Okay. If you are a greedy investor, you are most likely setting yourself up for failure, and it's just not going to work. We do not like to work with greedy clients. So if you're greedy, we may not be the right fit for you. Being greedy will lead you into a lot of bad situations. Okay, so do what you can control, and have a sensible, practical approach that's realistic, and don't treat the stock market like a casino. Because just like a casino, you may make a little bit of money here or there. If you play long enough, you're not going to beat the casino if you're greedy, right? And if you have a greedy investment approach with the stock market, same is true. Interesting fact, like Fidelity did this research on the Magellan Fund, which is like this huge mutual fund, and they have found that the people that were invested in the Magellan Fund over a 10-year period lost money. But the Magellan Fund was making like 12% a year over that time period. It was in the 90s. The reason for that is because people were greedy, and that brings us to our next mistake is do not try to time the market. So they were greedy and trying to time the market. It's not timing the market, it's time in the market. Okay? The more time you have in the market with the right strategy, the higher probability you're going to end up on the winning side of things and get to where you want to be. So we do not time the market, and you shouldn't time the market either. Now, we do have a rebalancing strategy, and we do adjust the asset allocation based on our current economic and stock market cycle. But these are adjustments on the asset allocation and not timing the stock market. Okay, so the fifth biggest mistake is not diversifying your portfolio properly. Okay, so most non-professional built portfolios are not diversified properly. That's just how it is. Diversification sounds sometimes like it could be easy, but it's actually quite complicated. There's a lot of research involved in order to properly construct a portfolio with the right diversification. And not diversifying your portfolio can lead you to a lot of problems down the road. Primarily being overconcentrated in a particular stock or sector or asset class, not keeping up with your asset allocation as markets fluctuate and go up and down. So you get skewed into one or the other type of diversification, far off what your target diversification is. So you need to take a very well-minded approach for diversification and stick with that strategy. Okay, so don't like start off in a diversified portfolio and then over time move into, when you hold like 30% of the portfolio in one stock and 20% in another stock, because like over time, it evolved and you're like, oh, this is a great opportunity is what you think. So let me go and buy this stock and I'm going to make like 100% on this because I know it's going to go up like crazy. So let me move outside of the proven system that works and take risk and put money into some individual sector or stock. And that's what happens all the time. So you just want to avoid that. Just stick with what works, okay? So the sixth biggest mistake is not backtesting your portfolio or backtesting your strategy. So if you haven't done the proper research on backtesting for your particular strategy over the last, let's say, 50 or 100 years, then you are competing against a lot of investors that have done that research and they have an advantage over you. So backtesting is key, and that's one of the specialties that Shorebreak Capital and Redwood Investment Management do, is a considerable amount of backtesting for every strategy. And we produce a report on that quarterly with the expected growth and drawdown possibilities with the portfolios. The portfolios have a 95% plus probability of meeting their objectives and staying within the growth and drawdown levels. Okay. So they are very well back tested, and you have a large team of very qualified people that are putting all this together that know what they're doing. So it's always good to just stick with what works. Okay. Number 7 is not building the correct asset allocation for your objectives. Okay. So you could have possibly a really good asset allocation, but if it doesn't align with your objectives and time horizon, then it could lead to a variety of serious problems down the road. So your asset allocation is like one of the most important things about an investment portfolio. And maintaining that correct asset allocation is paramount. So that's why you should talk with a certified financial planner like Steven, and he will help you construct an asset allocation that fits where you need to be. Okay. Number 8 is not paying hidden fees, front-end, back-end commissions, or unnecessary costs to your program. So if you just work with a fiduciary, you're going to bypass like all of this. But if you're not, you could be subject to additional fees that are like revenue sharing fees, that are back-end fees. The things that just are all embedded up into the program that you could find out about, but it's extremely difficult to, find out exactly like what's going on with some of this stuff. So if you just work with a fiduciary, you'll solve all that problem. But if you're not working with a fiduciary, you just have to keep an eye on that to make sure you're in the right investments for you, not your broker, right? So number 9 is not accurately determining your volatility exposure. So again, our whole strategy philosophy for investing is determining specifically what the volatility exposure is for each portfolio that we design and manage. So that gives you an idea of the possible fluctuations in the account. And our number one goal is not only to get you where you want to be, but to get you to that place that does not cause you any stress. Okay. So let us take the burden off of you, and you live your life, and we'll do what we do, and you live your life and not worry about your retirement and investments and what the stock market did yesterday and what it's doing this morning and what it's going to do tomorrow and what's going on with inflation, what's going on with interest rates. It doesn't matter. We handle all that. You don't have to worry about it. So the 10th biggest mistake is not having the correct time horizon in your portfolio for what you really need to have. So what the most common thing is getting into a time horizon, a long time horizon. Like, I'm going to keep my money there for 15 years. And then things change. You don't update your financial plan. And then all of a sudden you need to start taking money out unexpectedly. And it just so happens to be a really bad time to take the money out. So you have to keep up with your portfolio and make sure it's aligned with the time horizon. Steven can help you determine that and walk you through that and get you set up to where you are in the right portfolio for your particular objectives and time horizon. The other major issue with not having the correct time horizon is you could be forced to sell or do sell in a very bad time in the market. And the human brain in investing, they do not work well and well. The brain is set up to have a much more influential impact on fear for survival than a sensible, long-term, non-emotional approach. So the human brain has the amygdala, that is the fear center, and it will outweigh and outnumber the non-fear elements of your brain. And this is what causes market crashes and panic selling, is the amygdala in the brain, the fear component of the brain, making you think and getting emotional about, I have to sell because it's going to go to zero and everything looks really bad. So I freak out and sell. Okay. So you don't want to do that. You want to be in the right portfolio with the right risk tolerance, right time horizon, and markets will go up and down. You just have to keep with the system that works. So those are the 10 biggest mistakes in investing. Now I'm going to give you the 3 holy grails of investing. So the first holy grail of investing is be cautious. The market is not there to make you money. Okay. The market is a dangerous, dangerous place that, even though there's some really smart people that are in the markets, that does not mean that they are trying to help you. That means that they're smart and they're trying to make more money. And a lot of these people are not that ethical. So they don't have your best interest. They don't care about you, and they actively try to take money and move it from your account to their account. And unfortunately, a lot of the things that are out there are legal that do this, and you have to be very, very careful and approach investing in the stock market with extreme caution, and don't let your guard down. So think of it like you're going to be walking through an alleyway in a big city that has a lot of crime and everyone's out to get you. You have to be diligent and aware of possible threats or situations where you could get led into something that may not be in your best interest. So just because, again, people look really nice and maybe super smart doesn't mean that they could create a bogus company, for example, and make that company go public. So like a lot of times you have these attorneys that are smart and they like know how the system works, and they'll create these companies, they'll take them IPO, they'll figure out ways to get investor capital into the fund. And those are usually very deceptive trade practices, but they're legal. They ramp up the fund, and then the guy will sell all of the stock, and then it'll go to zero and everyone will lose all their money. So it happens all the time, and it's been happening all the time for probably since the stock market existed. So just don't let your guard down and be very cautious. So that's the first holy grail of investing. The second holy grail of investing is to not learn from other people's mistakes. So people have already done this. You don't have to do it. You don't have to stress out about it. Learn from other people's mistakes. Do not risk your own capital to try to figure out the market. That's a very costly way to try to figure out the market. And it could cost you a lot of money beyond your belief. So learn from other people's mistakes. The final holy grail of investing is you need a mentor, advisor, coach to help you get into the right investment plan and guide you to do the right things to help you reach your goals. So I don't care if you're the best of any sport, even the best of the best have coaches. And there's a reason for that, because they need them and that helps them get better. So get a advisor, coach, or mentor that can help you that has done it before. Okay. So those are the 3 holy grails. Now I'm going to go into Shorebreak Capital. So Shorebreak Capital is a registered investment advisory firm. We offer managed asset portfolios at Charles Schwab Institutional, a top-rated discount broker. And we have Right Capital, which is a software system that consolidates all the investment accounts and does all the reporting, asset allocation reporting, portfolio reporting, and is available at your fingertips on the web that Stephen can set up for you. During your onboarding, we'll set all this stuff up and then you have it available and you can see all your accounts. You can tie in other accounts, outside accounts, and put them all into one place, consolidate everything, put your whole financial plan into this one system, and then make things like really easy. So Stephen is the financial planner, and he can help you, work with you, figure out your financial plan, get you on board, get your asset allocation set up, get your portfolio set up, and do all that. So the portfolios are based on drawdown. So we do extensive analysis on the portfolio and how it may behave in the current market environment. So we have 5 portfolios with 5 different drawdown metrics. So we have the 5 to 7% drawdown, 8 to 12, 12 to 17, 17 to 25, and 25% plus. If you're obviously the most aggressive investor with a long time horizon, you would want the 25% plus. If you're very conservative, you'd want the 5 to 7. So they are very specifically designed to meet that threshold. And we also include in the portfolios co-investment institutional funds that allow retail investors to invest alongside the same assets and portfolios as the largest institutions, sovereign wealth funds, and pension funds. So this allows individual investors to get access to the best, highest quality assets. And we are able to do that through Shorebreak Capital. And typically, if you don't have your own firm set up like I do, and you work with like a bank or a big broker, in order to gain any access to this, you'd have to be in the private client group. And that means you need like 5 to 10 million of assets. You don't need that much to get into that. We offer that at the $100,000 level. Okay, because we're a pooled asset, we have the arrangements with the companies already that I've built up, since being in the industry for 20 years. That's all set up for you, and it doesn't cost you like any extra money. You just get tied into those really high quality assets. And by the way, those assets, which you can talk to Stephen about if you have more questions about it, but they have the highest Sharpe ratios in the entire market. And what does that mean? Well, that means your risk adjusted return is the best that is out there. And that means that for the growth that you get, the drawdown and volatility is less than the growth. So when you have a low volatility and not that many drawdowns, but then you have consistent growth and high growth, your Sharpe ratio goes up. So these investments have the best Sharpe ratios that you can find, and it's a really good way to diversify your portfolio and take advantage of it. So we offer the portfolios 75 basis points, 75% and 1% for the first year, and 95 basis points the second year. Very low cost. We offer additional financial planning services through Stephen. He can do comprehensive financial planning for you if you want as an elective service. If not, no big deal, but it's available for you if you want. And that is pretty much it. So if this sounds like something that would work for you and we're a good fit, then please set an appointment with Stephen, and he'll walk you through our platform, answer any questions, and learn about your situation, make recommendations. And then if you want to move forward, we will help you do onboarding, get you set up. Pauline is our relationship manager, which is also another resource to help you with the onboarding and just client communication, keeping up to date with things. So we can get you onboarded and get you going, set up, and you can move on and live your life and not have to worry about all this financial planning stuff. You don't have to watch the news about the markets. I don't recommend watching news about really anything. Let us do the work. Don't stress out about it. You don't have to be checking the stock market. You don't have to be like seeing whatever all the time. Like, what did this do today? What did that, like, Don't waste your time doing that. It's not going to get you anywhere. It's not going to do anything for you. And it's just a waste of time and it adds stress. Okay. So work with a firm that has everything already set up correctly and then just let it be. And that's going to give you the best results possible for investing. I hope you liked the video, and I really look forward to working with you. If you have any questions, again, please reach out, and hope you schedule your appointment with Steven, and I will see you soon. Thank you.